If true, this could be bad for the markets in 2021. Remember, my friends, the returns are contingent on two things, well, three things, but mostly two for, I would say long-term growth, certainly long-term growth, but any kind of significant growth. Earnings growth year over year plus dividend yield. All right, earnings growth year over year plus dividend yield. I got some sun shining on me there, so let me pull this back. Um, and then the appreciation of shares or depreciation depending on the demand, what consumers are willing to pay for a dollar of earnings. So I read this article, Earnings Growth Will Disappoint in 2021 by Lance Roberts from Real Investment Advice. I'm not familiar with Lance, but I thought this was pretty interesting. So let's go over this. It's that time of year when Wall Street analysts start trotting out the predictions for earnings growth and stock market targets for the coming year. Unfortunately, each year these overly optimistic estimates are ground down as the year progresses. Next year will be no different as earnings growth disappointed 2021. Goldman Sachs hits the ground running by putting a 2021 price target on the S&P 500 at 4,300 and 4,600 by the end of 2022. If we use our current level of 35.51, such a gain would be 21% in 2021 and 7% in 2022. Okay, to support that growth in stock prices, you need strong earnings growth to keep expensive valuations at some less crazy level. To accomplish that, Goldman stretched reality to 175 earnings per share in 2021 and 195 in 2022. Let's see. Note that Goldman used 136 in operating earnings before reality for 2020, which is currently 16 per share higher than the S&P is currently presenting. Assuming that Goldman is correct, such a valuation would put the S&P 500 at 24 times operating earnings and 23 times in 2022. Such levels remain extremely expensive by any historical measure. The problem with estimates: for years I've counseled individuals to disregard mainstream and analysts, Wall Street recommendations, even Morningstar ratings due to the inherent conflict of interest between the firms and particular clientele. Here's the point. You are not Wall Street's client. You are the consumer of the products sold for Wall Street's clients. Wall Street is a big business, and I mean massive industry, $715 billion a year in revenue. The table below shows the annual sales of the 22 largest financial firms in the S&P 500. And you notice Vanguard won't be in here. Why? Because they're a mutually owned company, essentially. Look at that, man. $715 billion in revenue. Like all businesses, these companies are driven by increasing corporate profitability annually, regardless of market conditions. You are not Wall Street's priority. Countless studies have shown that forecasts and stock recommendations of sell-side and analysts are questionable value to investors. As it turns out, Wall Street sell-side analysts are primarily interested in making accurate stock picks. Their attention lavished on their forecasts and recommendations, predictive accuracy just isn't their main job. Their main job is to make money for Wall Street. How important are the following to your compensation? The profitability of your stock recommendations is only very important. Your industry, look at that, way down here. The accuracy of your... So the survey response to the questions, how important are the following to your comp? Number 8 and 9 are the profitability of recommendations and the accuracy of your recommendations. Look at that. How important are the following clients to your employer? Retail brokerage accounts, the last. Hedge funds, mutual funds, defined benefits, insurance firms, endowments for high net worth individuals, retail brokerage accounts. They don't care about you, man. They don't care about you. Where are you in order of importance? Well, you're at the bottom of the list, and such is because accuracy isn't essential. It's only the broker votes that matter. A broker vote is an internal process whereby clients of the sell-side analyst firms access the value of the research and decide which firm services they wish to buy. The process is crucial to analysts because good broker votes result in revenue for their firm. One analyst noted that broker votes directly impact my compensation and directly impact the compensation of my firm. I don't even know what a broker vote is. I haven't heard of that. Right here, your standing in analyst rankings or broker votes is number 2 most impactful thing for compensation. No accountability. The problem is that no one in the financial media, Wall Street, or anywhere else holds analysts accountable for the calls. Let's take a look at the table below using the data from the S&P 500 Global. Initial estimate for the year, 112. Actual estimate was actual year-end earnings per share was 100, so they're down 12%. Look, they always missed it by just the average miss was 27.9% higher than what was actually reported. Look at that. 2013, 14, 15, 16, 17, 18, 19, 20, 21. Look at that, man. The difference was an average of 27.9% too high. I've stated previously that analysts consistently overestimate earnings by as much as 30%. However, this just isn't a recent event, as two charts from Yardeni, I think it's Ed Yardeni, if memory serves, show below operating earnings per share, analyst estimates. All right, so let's see, we got estimates. I can't tell what that means. Does that mean they're? I'm not sure what that. I can't read that. I can't say that doesn't mean. Of course, the problem is that investors take these estimates from analysts at face value and pay up for the earnings that fail to materialize in the future. Such works out great for Wall Street, who makes their investment banking clients happy. However, not so much for the retail clients whom they're offloading overpriced shares. 2021 is likely to be disappointing again. While analysts are rushing to set the highest target price possible and overestimating earnings to justify them, the next 12 months will see those targets sharply reduced. Such was a point we made in April this year. To wit, the analysis is based on the presumption that despite the fact that the major buyer of stocks, namely corporate share repurchases, will be missing, that earnings will recover sharply once the economy opens back up for business. To analyze the reality of these expectations, we need to review the history of estimates for the S&P 500. It's just the reason I'm laughing so much is because we can yell and scream bloody murder at the Wall Street and say, when are we going to hold you accountable? I look at academia all the time. When are we going to hold you accountable, academia? Neil Ferguson of Imperial College of London. You've never been right. You've always overestimated the risks of various pandemics and viruses. And yet this guy is still freaking making bank. Michael Mann, you've always been overestimating the risk of climate change. Not one thing has ever happened like you guys predicted. Just when are these guys going to be held accountable? So it's not just Wall Street, it's all the academics, it's all the titans of industry. We just have this like pedigree. If you have the pedigree, we have to believe you, because who else are we going to believe? How about you just don't believe anything? Just move on with your life as you see fit. Right. Current estimates for 2021 sit at 143.09. Importantly, with markets presently sitting near all-time highs, 2021 estimates are $30 a share lower than was initially estimated. Economic recovery won't make up the difference. Over the last couple of weeks, we've touched on various problems with the expected recovery, even if we get a vaccine in place. Foremost, the hope that consumers will rush out to spend money due to pent-up demand is likely not the case. Had the government not acted to send money directly to households, I would agree with this sentiment that once we open it up, we'll be out there ready to buy. However, the flood of stimulus money from direct checks to households and expanded unemployment benefits pulled forward future consumption. I completely agree. That comparison between retail sales and current retail sales in 2008, where stimulus was not present, is evidence. I'd have to look at that more. Anyway, second, the divergence between stock market and the economy is unsustainable longer term. I completely agree. Since 1947, EPS, earnings per share, has grown at 6.21% annually, while the economy has expanded by 6.41% annually. That's pre-inflation, by the way. That close relationship in growth rate should be logical. Such is particularly the case given the significant role spending has in the GDP equation. The correlation is more evident when looking at the market versus the ratio of corporate profits to GDP. With 90% correlation, investors should not dismiss these deviations. That's if there's no corporate profits, you're going to have a hard time making money in the markets. Most importantly, economic growth will not recover back to pre-pandemic growth trends, as noted by Michael Leibowitz recently. The new paradigm of weak recoveries is due to the Fed's policy prescription for recessions. Debt-fueled consumption. Through lower interest rates, they incentivize people, corporations, and the government to borrow. The benefits are here and now. As the economy recovers, the cost is paid tomorrow. Yep. In simpler terms, we pull consumption forward from the future during each recession and accumulate debt in its place. Accordingly, future economic growth is weaker than in past as debt diverts income from productive investments into debt service. Yeah, I completely agree. So we'll stop there. Again, earnings drive everything, man. And you can have, like, in 2018, there's there's great earnings and bad stock return. 2019 was great, bad earnings and great stock return. So it could be off a year, could be off 2 years. In the aggregate, though, earnings drive stock prices. Where are you going to get the earnings from? I mean, the big companies maybe, but the S&P, the total stock is consumed. There's a whole lot more than just big companies in the U.S. stock market. Something to think about. All right, we'll see you. Love to hear your comments.